Hi guys, so today we'll be focusing on study unit 1, which looks at special deductions. And after this learning module, you will have a thorough knowledge of special deductions, and you'll be able to apply your knowledge on special deductions to calculate taxable income. So before I go ahead with the special deductions, I think that it is important to firstly go through the general deduction formula, or some general deductions, which is knowledge that you should have previously covered, and it is knowledge that you will see in any test or any question that you find. So it is background knowledge which you should know, but I feel it fit to just quickly go through that knowledge so we can focus on the special deductions. Okay, so as with the gross income, which had a set definition, deductions also has a set definition, which is something you will have to study, and it's something that you will always have to ask yourself when determining any deduction, is whether any item you are considering conforms to all items of or all elements of the definition. Now, with deductions, we get our general deductions according to the formula, which I'm going to go through now. Then there are some prohibited deductions, so that's section 23 and the negative test, and then also some specific deductions as determined in section 11b to 19. So let's start with general deductions. So again, the formula or the definition for a deduction or general deduction is, firstly, you need to carry on a trade. Any expenditures and losses actually incurred during the current year of assessment in production of income which is not of a capital nature and laid out or present for purposes of trade. So importantly, for any deduction, all these elements should be present. If not, then it is not a deduction, an allowable deduction, if it's not specifically included as a specific deduction. Okay, so breaking down that definition. So let's start with carrying on a trade. So what is a trade? A trade includes any profession, trade, business, employment, calling, occupation, venture, letting of any property. That's an important one. Use of, grant of permission to use, patent, design, trademark, copyright, or any other property of a similar nature. And it excludes any passive investment activities, so in other words, your interest, dividends, annuities, or pensions. So in other words, just your investment you make on the sideline, that's not a deduction because it's not part of carrying on a trade to make an income for you, unless you have an intention to buy shares or to speculate in shares. So then that will be carrying on a trade. So it's classified as a trade. So venture, so transactions whereby a taxpayer risks something with object of making a profit. So that's a venture. Interest income, this mostly relates to banks. So that's the carrying on of a trade unless a money lender, so interest expenditure incurred in the production of interest income, that is allowable deduction, and it is limited to the interest income. Cases, so carrying on of a trade involves active step, so something more than watching over existing investments that are not income producing and are not intended or expected to be. Mere retention does not imply a trade, essentially. So the important thing about this is there has to be an active step. You have to actively work on your investments to produce an income for you. If it's just something on the sideline or some passive investing, then it is not carrying on of a trade. So important questions to ask yourself is, firstly, is there a continuity of activities? If yes, then it's carrying on a trade. So in other words, what you do this year is the same next year, is the same the year after. If yes, then it is carrying on a trade. And the second thing is, or the second question you need to ask yourself, is there a long-term objective of this trade to generate a profit? If yes, then a trade may constitute the carrying on of a trade. So carrying on of more than one trade, you can have more than one trade. You just need to basically split them up and add up the net amounts of each trade. Okay, so you need to look at them separately, so income minus expenditure, and then you're going to add them together. Okay, as we mentioned above, there has to be a profit motive. So there are certain cases. So ITC 1292 said the test, there has to be a real hope or reasonable possibility to make profit. Hope must not be based on a fanciful expectations. De Beers, absence of profit motive is not necessarily exclude tax from being part of taxpayer trade. And yeah, you can go through that. So Burgers just focus on a taxpayer must be carrying on a trade. So the fact that no continuity, lack of profit motive does not mean that the trade is not being carried on. So if there's no reasonable expectation of profit, then expenditure more than income is disallowed. That's this SAR practice. When does a trade commence? So that's also important. When did you start this trade? So when an object of the business is to earn income, then this stage not reached until the business in position to start earning. Can only deduct expenditure when actual income producing operations have started. So that's important. So you may only deduct expenditure when actual income producing operations have started. But remember from the income definition, any income it has to be received or incurred. So you may incur an income on today, but you only receive it next year. But because you incurred it, then that means it is income for you that you need to include within the definition. Okay. So pre-trade expenditure is normally only deductible if taxpayer carrying on a trade. Expenditure incurred before trade is commenced is deductible in the year trade commenced. So in other words, those are any expenditure made before you produced any income or before any income was produced. So in other words, it is in preparation of your income. Okay, so that's section 11A, and that's also something we're going to have a look at bit later. So what are the requirements? So requirements are that it needs to be incurred prior to commencement and in preparation of carrying on a trade. So preparation and prior to commencement. The expenditure would have been deductible in terms of section 11 had that person started trading before incurring the expenditure. Expenditure not deducted before. Okay, so yeah, you need to know these requirements. So in preparation of carrying on a trade or prior to commencement, these deductions, it should be normal deductions in terms of the definition. Had the person started trading before and the expenditure not deducted before. So it's something that should not have been deducted in the previous year of assessment, or yes, any deduction made before. Okay, so laid out, expanded for purpose of trade. So expenditure may incurred partially for trade or private. So this is basically just breaking down what is expenditure. So you will get a question, or you might get a question where they tell you you work from your home, and in your home is 200 or let's say 100 square meters large, but you only use 30 square meters, or you have a private study in your home, and that constitutes 50 square meters, and that is what you use for carrying on your trade or for your business. So what you can do is you can calculate from your water and electricity or insurance that 50% or that 50 square meters, 50 out of 100 square meters, you may deduct as an deduction, or the expenditure you may deduct for water and electricity, insurance, or any other expenditure. Okay, so yeah, that's just exactly what I said here. So a portion of floor space, that's what I just went through. So bond payments. Okay, so if we just look at this example, it says the total floor area of a home is 160 square meters. 40 square meters is a consulting room. So the bond payment, you may deduct 60% of the bond payments each year. Electricity, 18,000 times 40 over 160. So yeah, you just need to go through it. And with time, so you went on holiday or you went away, 6 days was for business, 4 days for holidays. In other words, 6 of those days you may deduct as an allowable deduction if it was in terms of carrying on your trade. Okay. Okay, expenditure and losses. So Joffe and Co., they define expenditure of somewhat obscure. It's not clear if difference from expenditure. Loss is involuntary, expenditure is voluntary. So expenditure does not restrict to outlay of cash, includes any form of cash. So yeah, expenditure is not just cash, any form of cash. And cost of asset given the amount of expenditure. So if there is no actual cost, you need to use the market value. That's according to Lay's proprietary minds, and that's also what we did in the income definition. So actually incurred, what is the meaning? It doesn't necessarily mean incurred. There's a wider meaning, and this does not need to be necessary. SARS can't dictate how the taxpayer should operate his business. PE crime rate determined that if actual expenditure complies with requirements of Section 11A, then that is deductible, irrespective if necessary or not. Excessive expenditure be deductible. Caltex Oil, expenditure incurred equals expenditure actually paid. The liability to pay expenses equals incurred and deductible. Therefore, you may deduct this expenditure. Nationale Pash, BPK, so that's actually NASPASH, if you don't know. So if no definite or absolute liability during year of assessment to pay, so expenditure has not been actually incurred, so clear legal liability exists, so then you may deduct. EDGAS, we all know EDGAS, so they went and said principle 1, the only expenditure in relation to the taxpayer is incurred, so unconditional legal obligation during the year of assessment may be deducted. So again, it needs to be unconditional, this expenditure. And that's also, if you remember from the gross income definition, income should be unconditionally earned. Okay, if conditional, then deduct when fulfilled. So you may only deduct, make this deduction when that condition is fulfilled. So principle 2, estimates of contingent or uncertain does not mean the expenditure is incurred. So if expenditure incurred, then you can't be quantified, so the amount must be estimate, and that is the deductible amount. So section 24 specifies that a quantified amount is if acquired by person A for consideration, then it's not quantified. Unquantified portion deemed does not deemed to be incurred. So when quantified, then it's incurred. Okay, so it's a lot of things to note, but just remember that it is something that incurred, and it's something that unconditionally, yeah, it's there should be no conditional conditions to this deduction or to this expenditure. Okay, acquired asset as a capital asset. So again, change of intention. So if there was a change of intention, then you need to determine again the fruit or the apple, which we did in the income definition. So section 11A determines that deduction should be the current market value or the original historical cost. Okay, so year of assessment, again, that's just the current taxation or tax year. So it's not in an act, it's not specifically mentioned in an act, so no expenditure incurred in particular year of assessment may be deducted in subsequent years. So whatever happened during this current year of assessment should be deducted during this current year of assessment. If the deduction not claimed and incurred, it cannot be claimed in a later year. So if RK matching principle, so the amount expenditure is prepaid, so tax, the expenditure includes the expenditure deductible in year actually incurred. So tax expenditure incurred in current year deductible. Very important, possible section 23H, prepaid expenditure limitation, so we're going to go through that. But again, as I said, it should be during the current year of assessment, any amount you received or amount incurred. It doesn't mean you have to actually pay the amount during the current year. It can be an amount incurred during the current year of assessment. Okay, in the production of income. So this is a very important question you need to ask yourself is, firstly, is this expenditure during the course of carrying on a trade, and is this expenditure used in the production of income? So is it gonna lead to income to you or your business? So income, according to section 1, which we covered, income is your gross income plus special inclusions minus exemptions. So no deduction if it does not relate to the production of income as defined. So expenditure that lead to the capital receipts or exempt income is not deductible. Section 23F says no deduction shall be made in relation to expenditure incurred or amounts received accrued which do not constitute income. So as I said, this expenditure should be in the production of income. If it's just your normal, your normal cost for food or whatever, that's not related to your trade, so it's not going to lead to income to you, so it's not a deduction. So the important cases are PE Electric Tramway. They said that the compensation paid to the deceased dependents, the production of income necessary concomitant of taxpayers' business activities. So the intention of the business is to produce income. So that's deductible. Legal cost for defending claim is not deductible. Not carried with intention of producing income, so specific deduction for legal costs. So that's section 11C. So that's also something we're going to cover today. So is expenditure linked closely to the production of income? So two questions arise. Firstly is the subjective test. What action gave rise to this expenditure? Is it in the production of income? And secondly, is this action closely connected with or necessary concomitant of the income earning activities, the objective test. So steps to determine whether this is in the production of income is firstly to identify the event that led to this expense. Secondly, the event must have occurred as a result of income earning activities, so intentionally or inherent risk, and identify expenditure resulting from event. Expenditure must be closely linked to income earning operations to be seen as part of cost of operating it. Sub Nigel said that it's not necessary that the expenditure produce income in the same year as the expenditure incurred. So only expenditure was incurred with intention to produce income. So he basically just said what we mentioned above is the income, well, the expenditure does not necessarily need to relate to the year when the income was received. Okay, Jaffe & Co. is also a familiar case in the Tax Act. So it says that events that led to expenditure must be necessary for business activities. In the case it went and said negligence is not concomitant, so in other words it's not deductible. Very important is the negligence, it's not always conclusive. So you need to ask yourself whether expenditure was incurred with purpose of producing income, If not, then it's produce income, or the purpose for which expenditure incurred, receive proceeds, then it's not income, or protect capital assets. So specific items, fines and bribes, theft, and recurrent costs. So fines and bribes, that is not deductible. It's not necessarily concomitant of income producing activities. It's not in production of income, in conflict with public interest. But Section 23.0 says specifically prohibits deduction of fines, unlawful kickbacks, bribes, penalties due to unlawful activities. So fines and bribes, it's not a allowable deduction. Theft, it's yes or no, can be included or maybe not. So it's necessary, concomitant of business activities. Yes, if yes, then it's deductible. If not, then it's not deductible. So in other words, it's with the supermarket. If there was theft of items at the supermarket, then you may deduct those items that were stolen because it is a loss to you. If it's completely unrelated, then no, you may not deduct it. So Rendell said there needs to be a close link between the theft and the activities. Then it may be deducted, an allowable deduction. So theft by a manager, proprietor is not deductible, not inevitable, concomitant. So it's just, so that's an important thing. If the managers went and stole some items, then it's not an allowable deduction. Recurrent costs, so some recurrent expenses not incurred in a production, but is allowed as a deduction by SARS. Practice note number 22, which printing of annual financial statements, annual listing costs on a JSE, compensation of transfer secretary. So practice note 37, payment to accountants, bookkeepers, tax consultants, admin costs. So these are, so it is actually allowed as deductions by SARS. So it's just your normal cost for the company in preparing the financial statements, your payments to your accountants, bookkeepers, just your normal stuff. So you just need to, again, it's for the carrying on of a trade. So yes, it is deductible. So remember, with expenses, it must be incurred for purpose of earning income. In relation to exempt income, dividends, it's not deductible. Need not lead to income, but necessarily closely connected to risk of business in terms of what would then be deducted, allowable deduction. So these are important things for you to remember and to always ask yourself. Okay, again, as with the income definition, we have not of a capital nature or of a capital nature. So it's not in an act, so capital expenditure is not deductible. No definition exists. So tests and standards. So there are certain tests that you need to do which will determine whether an item is of a capital nature or not. So you need to firstly determine what is the true nature of the tax, what is the relationship between expenditure and the income earning operations, the creation of enduring benefit for business, fixed versus floating capital expenditure, once-off expenditure, nature of business activities, and no halfway house between capital and revenue nature. So what are the true nature of the transactions? So look at the nature of transactions to determine if expenditure is deductible. So new stage areas, the purpose with which the expenditure incurred, acquire capital that will produce income, so that's capital nature. For costs, incidental to income producing activities is not of a capital nature, even if there's a lump sum payment. Okay, so the relationship between income and earning operations. So new state areas, that's another case. So again, determine the relationship between expenditure and income producing structure, the apple and the tree. So yeah, you can go through this on your own, but it basically just focus on these. What are the true nature of the tax or of the transaction? What's the relationship between expenditure and income earning operations? Creation of enduring benefit for business, fixed versus floating capital expenditure, once-off expenditure, and nature of business activities. So these goes into much more detail, but they are very logical, so you can go through them on your own. But even then, you will be able to know and understand what is of a capital nature and what is not. So section 23, these are your prohibited deductions. These are deductions not allowed in terms of the Tax Act. So irrespective of whether section 11A is applicable, deduction of certain expenditure is prohibited in terms of section 23. So even if it did conform to the definition above, you may still not deduct this as a deduction. Okay, so the maintenance of any taxpayer in terms of section 23A, so the cost incurred of maintenance of any taxpayer, family or establishment. So whatever you pay to your family or your wife, it's not deductible. So the Commissioner of Internal Revenue versus Hickson said that the means to feed himself and family, providing with the necessities of life and comfort, maintaining a certain standard of living, keeping up the establishment. So this is your private cost, it's your private expenditure. It's not allowed as it's not really allowed as a deduction. Domestic or private expenditure, that's section 23B. It's really very much related to section 23A, and it includes your rental, cost of repairs, expenditure in connection with any premises not occupied for purposes of trade, dwelling house, domestic premises, so there's no deduction. So as we went through earlier, if you have a house and you only use one small room for your trade, then that small room, that portion of that small room, that is deductible. The rest of the house, that's your private use, so that is not deductible. Very important, a part will not be deemed to occupied for business purposes unless you can prove it is specifically equipped for the purpose of the taxpayer's trade and regularly and exclusively used for business purposes. So SARS may come to you and they may do an audit on you and see whether that room, whether it is the 40 square meters as mentioned earlier, and whether that room is the only room or whether that room is being used by you for carrying on your trade. Okay. So no deduction is allowed in relation to private residence when a taxpayer trade constitutes any employment or offices, unless income derived mainly is more than 50% from commission and its duties are mainly performed in place otherwise than in an office provided by his employer. So again, if you want to have your small room at your house and you work for an employer, then the money you earn should be, or more than 50% of the money you earn should be earned while in that room. Then it may be deducted. Otherwise, it's not a deduction in terms of section 23B. It's a prohibited deduction. So to qualify as a deduction, so not prohibited in terms of section 23, so the relevant part of home must be specifically equipped and regularly and exclusively used for business purposes. Recoverable expenditure, section 23C, so loss or expenditure would otherwise be deducted to extent to which it is recoverable under any transaction of insurance, guarantee, security, or indemnity is not be allowed as a deduction. So it's what it says. If you had a loss, for example, if your house burned down or whatever, and you can claim back that money from the insurance, from an insurance company, then no, it's not an allowable deduction, or it's a prohibited deduction. So interest, penalties, and taxes. Section 23D, taxes levied in terms of the Income Tax Act, income tax, donation tax, penalties, interest, additional tax in relation to the VAT Act. So these are prohibited. You may not deduct taxes because you're actually calculating your taxable income, and now you want to deduct other taxes that you paid. So that's a logic one. So provisions and reserves. Section 23E, income carried to any reserve fund, capitalized in any way, not actually incurred. No unconditional liability. Okay, expenditure incurred to produce exempt income. So that's, yeah, we went through exempt income when we went through the gross income definition. So section 23F said that expenditure incurred in relation to amounts not included in income is not deductible, exempt income or not gross income. For example, interest on loan used to finance shares on which dividend is earned. It's not really something you will find in a test, but yeah, just take note of that. So non-trade expenditure, if not for purpose of trade, then it's not deductible. So it's in the definition of deduction. If it has to be in relation to a trade. If it's not in relation to a trade, then no, it's not an allowable deduction. Notional interest, deduction claimed against retirement fund lump sum, expenditure incurred by labor brokers and personal service providers. You can go through these, but it's again logical. You can you can just read through them. So restraint of trade, section 23L. So expenditure incurred in relation to restraint of trade, unless it is allowed in terms of section 11CA. So again, we're going to go through that a bit later in your special deductions, but yeah, you just need to know it's a prohibited deduction, but there is section 11CA goes into detail and it allows certain restraints of trade. There's certain conditions that needs to be met. So expenditure relating to employment or offices, we went through that earlier. So government grants, you're not allowed to deduct any grant that you receive from government. Unlawful activities, again, it's corruption, it's unlawful. So for you to deduct it, it's logical. It's not. You need to include any unlawful income that you received, but you can't deduct any unlawful expenditure. Okay. So double taxation in terms of section 23B. None of the specific deductions can be claimed if the expenditure have already been deducted in another section of the Act. Yeah, so that's again logical, but that's not something you will find commonly. Okay, cost of assets and VAT. The taxpayer is the vendor as defined of the VAT Act. That we'll do in the subsequent weeks, but we'll deal with the VAT Act. But the taxpayer is and was previously year of assessment entitled to section 16 of the VAT Act to deduct any income input tax. Then the amount of such input excluded from costs or the market value of an amount of such expenditure. So yeah, just know that any input VAT or any VAT related stuff is dealt with in the VAT Act, and this section also relates to double taxation because it's already allowed, it's already a deduction in terms of the VAT Act, so you can't deduct it again. Okay, leave pay, prepaid expenditure, these are all tests that you need to go through on your own, but yeah, you just need to read through them. Okay, special deductions. So that's the focus of today, special deductions. So these are so this section goes into much more detail goes into a lot of detail, and it includes many other special deductions which is not covered in your study guide. So it is worth you going through this and worth studying this and understanding this. You need to go through this with your Silk book, because Silk book has some examples which you can reference, and it also explains it in much more details. And there are some other study resources you can use from the Silk book for you to learn. So yeah, get that book and go through that. Okay, so pre-trade expenditures. So these are expenditure made before any income was generated from your trade. So it's applicable to any expenditure or loss actually incurred. So it's something that has incurred prior to the commencement of and in preparation of trade to which it relates. So you might not necessarily have received the income yet, but it's an expenditure which you incurred before you embarked on a contract. So, for example, any construction work, you need to you incur some expenditure to get the material and and stuff like that before you can start with your constructing a house or whatever. The requirements are that the expenditure or loss would have been deductible in terms of Section 11 had it incurred after commencement of the trade. It's not allowed as a deduction in the year of assessment or any previous years of assessments. So again, the requirements is that firstly, in the normal course of business, it should conform to the definition of a deduction. If yes, then that's one of the requirements. And the second one is it's not allowed as a deduction. If you previously deducted it in a previous year of assessment, you may not deduct it during the current year of assessment. Okay, so when can you claim this deduction? In the year of assessment, when you commence this trade. So it's restricted to income of that trade for the year or part of the year, the ring fence. So we'll also go through that. Okay, so legal expenses. Legal expenses in terms of Section 11C is a specific deduction, and it is any cost incurred in the production of income. You can't deduct the legal expenses for you fighting with your neighbor because he plays his music too loud or anything like that. It has to be in the production of income. It has to relate to your trade. So it's an allowable deduction. So what can you deduct? What expenditure can you deduct in terms of legal expenses? So firstly, fees for legal practitioners, expenditure to obtain expert opinion, court fees, witness fees, tax costs of sheriffs and messengers of court, and any similar. So the requirements are that it should actually incur during the current year of assessment in relation to any claim, dispute of action at law, in course of carrying on a trade, not of a capital nature, and expenses must be in relation to claim by or against the taxpayer, which will be taxable if he wins the case and is deductible if he loses case. Okay, so again, it has to relate to your trade. It has to relate to the production of income. So Section 23H may limit the deduction if all services will not be rendered to the taxpayer during the year of assessment. We'll go through that a bit later. So the capital expenditure is not deductible. Expenditure incurred not allowed if payment defended. Amount received was not allowed in relation to Section 11A. So it has to be included in your gross income. Okay, restraints of trade. This is a specific deduction which we went through earlier, where it said it's prohibited, but there are certain conditions which allows it to be deducted. So generally, It's not deductible because it's of a capital nature, but made on or after the 23rd of February 2000, then the amount actually incurred as compensation in relation to any restraint of trade imposed on any person who is a natural person, to the extent that the amount constitutes income in hands of the person to whom it is paid. It's limited to deduction will not exceed any 1 year the lesser amount of the amount incurred divided by the number of years of restraint, or a third of the amount incurred. So deduct over a period of which relates to, but minimum period for writing off is 3 years. So basically what this means is, well, we'll go through it in the slides, but it's essentially when you as an employer train one of your employees some trade secrets or some specific knowledge which you carry over to your employer. And if this employer leaves you and starts his own business or goes to one of his competitors, then you may set up a restraint of trade contract, which states that he may not use this knowledge or this intellectual property for a period of, let's say, 4 years, 5 years, or whatever, which is normally 5 years. And if he does use this, information, then he'll be liable for some penalties which he needs to pay to you. But now this is a allowable deduction or specific deduction, and you need to determine which amount it is, and the amount is the actual amount incurred divided by the number of years of restraint, so divide by 5 years, or a third of the amount, whichever one is the least of these two. That is your allowable deduction. Okay, so repairs in terms of section 11D. What is allowed? So expenditure actually incurred during the year on repair of property occupied for purpose of trade in relation to income receivable or rent. So repair of machinery, implements, utensils, and other articles used in trade, or for beetle treatment of property. So yes, you may deduct any repairs to if you have a rental property, or if you need to repair any machinery of yours, then that is an allowable deduction. So in the repair, you need to first determine what is the reason for the expenditure. If it's needed to be repaired, then it is a repair. It's a restoration by renewal, replacement, or subsidiary parts. If expenditure incurred to improve, then it's not a repair. So it's only it's an improvement. So claim capital allowance. Repairs versus improvement. Repairs is fully deductible. Improvement, capital allowance will apply. So we'll go through that a bit later. But again, if it is repaired to renew or replace something, then that's a repair. Or if it's only to improve, then it's of a capital nature. So you may claim a capital allowance. Okay, so repair is a restoration by renewal or replacement, not necessary that materials used are identical. Restore to original condition, intention of taxpayers to restore to original, then that is a repair. An improvement incurred in income earning capacity, lead to improve or to better an asset, that is improvement. Okay, bad debts, section 11I. Deductible in relation to amount which are due to taxpayer, become bad during the year of assessment, and where it's included in taxpayer income during the current year of assessment or any previous years of assessment. So the bad debts arising from money lent to the employee, not deductible since the amount of debt would never have been included in the lender's income. So bad debt from sale of goods is deductible amount of debt included in taxpayer income. So in other words, what this means is yeah, it's any debt which you will not recover. It's your it is your debtors or people that owe you money because you have credit sales and they don't pay it back. You know that they won't pay it back. Then that amount which you write off, that is an allowable deduction. So doubtful debts, it's very much related to your bad debts. It's just debts that you believe will not incur during a current year of assessment. So we'll go through that a bit later, but there's a formula, or there is only a portion of that is allowed, and it's 20% of the list of allowance of deduction. If the debts would have been allowed as bad debts deduction, an allowance must be added back in the following year. Okay. So if it's not less, then you need to use the formula of y equals m times n. So y is the allowance to be made for doubtful debt. M is the average of bad debt written off. Bad debts recovered over a period of 5 years, expressed as a percentage of annual credit turnover. And N is the outstanding balance at the close of the year of assessment. Okay, so any contribution by the employer to a pension, provident, or benefit fund, that is an allowable deduction in terms of Section 11L. So the requirements are that if the contribution is a lump sum, then a commission may allow deduction in yearly installments. So yeah, you need to determine what yearly installments there are. Then that is your deduction during the current year of assessment, the next year of assessment, and so forth. So if the contribution per employee is more than 10% of the approved remuneration, then the commission may disallow entire or disallow everything above 10%. So practice, commissioner allows contribution of 20% above the remuneration. So yeah, you can go through that by your own, but we're going to go through that in more detail. So shares issued by the employer in terms of Section 8B, so that's your BEE or stuff like that. You can read through that. Okay, so annuities paid to former employees on retirement, that's also very similar to this contributions by the employer to any pension fund. So if you pay any annuities to former employees, that is deductible, but the condition is that the employer that retire due to old age, ill health, or infirmity. So you can't work anymore. So dependents of former employees, person must have been dependent for maintenance upon former employee immediately before death. So that's an important one. So any dependents of former employees. So if a former employee receives an annuity and he dies, then you need to determine whether the person must have been dependent for maintenance upon the former employee's immediately before his death. So that person rely on the annuity from the former employer. If yes, then it is an allowable deduction. Otherwise, no, it's not. And former partners. So if a partner in a company or business retires, then due to old age, ill health, or infirmity, then that's an allowable deduction. The partner should have at least been a partner for 5 years. An amount paid is reasonable in light of services and profits. Okay. So repayment of employee benefit, you can go through it on your own. It's essentially what we just covered. Repayment of employee benefits, same thing. Other deductions, deductions of amount allowed in terms of any provision of other than the Section 11. So that brings into Section 11 all other deductions under any other section. Okay. So medical lump sum, we're going to do this a bit later, but that's Section 12M. So some employees, in terms of their employment, are entitled to their former employers making contributions to medical aid scheme after their retirement So the employer has a liability. The employer would like to get this conditional liability off the books and make payment to the employee. So in other words, then it is for the employer an allowable deduction. The medical aid contributions. Donations. Donations is an allowable deduction, but very importantly, in terms of section 18A, there should be a receipt, a section 18A receipt. If there's no receipt, then you may not deduct any donation. Okay, I'm going to go through this as well. Okay, so those are all your deductions. The only last thing I want to go through is assess loss, because that's also something that we're gonna go through now in the slides, and something that you should know. But basically what an assessed loss is any loss in your taxable income calculation that you made. You may bring it forward to your current financial year, and you may it's a deduction for you, so it will make your current year's taxable income less. Okay, so an assessed loss is when your deductions allowed is more than your total income. So the taxpayer is allowed to deduct from income tax in the year of assessment. So the balance assessed loss brought forward from the previous year. So you are allowed to bring the balance of your assessed loss from the previous year forward to the current year and as a deduction. Okay, so assessed loss incurred during the current year of assessment of any trade in the Republic. So under normal circumstances, a loss made out of one trade can be set off against the taxable income of another trade. Okay. So the requirements are that the taxpayer be carrying on a trade, income must have accrued to the taxpayer, and exceptions to balance of assessed loss being set off, so that when the person's estate voluntary or is sequestrated, then you're not entitled to carry forward the assessed loss made prior to this sequestration. Okay, and yeah, you can go through that on your own, but we're going to go through that in a second. Ring fencing, that's not important now, so you can just read through this. There are some certain steps that you need to determine in order to ring fence something, but yeah, it's not something that we're going to deal with this year. Okay, so let's have a look at what we will be dealing with today. Okay, so as mentioned previously, today we're going to focus on specific deductions, but I had to go through your general deductions and your prohibited deductions because it's prior knowledge which builds onto the special deductions, and if you don't have that prior knowledge, then you won't be able to do this special, or you won't be able to go through this section. Okay, so as I said, after this you will have thorough knowledge on special deductions, and you'll be able to apply this knowledge on special deductions to calculate your taxable income. Now, how do you calculate taxable income? Firstly, you need to determine your gross income as per definition section 1.1, less any exempt income. So that's normally your dividends and interest, and that gives you income. Then and that's what we're going to focus on now, is you need to deduct any deductions and allowances. You should also deduct any assessed loss in terms of section 20 to 20b from a previous year of assessment. Then you can add back any amount included in taxable income. You may add back taxable capital gain, You need to subtract deductions in terms of section 11F. We're not going to focus on that today. And you should also deduct deductions in terms of section 18A. So that's also something that you'll deal with at a later stage. So that gives you your taxable income. Then you need to take this taxable income and you do calculate your normal tax per the progressive tax table, subtract any tax rebates and credits, and that gives you your normal tax payable. So just a quick summary on your tax table. This is for the 2018 year of assessment. That's the one you'll be using most often. And these are your tax rebates. So you need to know these, and yeah, it's an easy mark for you. This you will get in a test. This tax rebate you will not get in a test. So you need to know this. Okay. So what are we doing today? There are some specific expenditures within a trade or business that are allowed as a deduction under the general deduction formula, as what I went through earlier when we dealt with the general deduction formula. But other may be of a capital nature, and that is not allowed. So you always need to ask yourself whether this expenditure have been incurred in the production of income. That's the most important question for you to ask yourself. So certain special deductions are allowed in terms of the income tax, and that's the focus of this learning module, is on these special deductions. The first one that we're going to look at, and that's something we dealt with earlier, is pre-trade expenditure and losses in terms of section 11A. So what is the trade? Trade is carrying on of a business venture. So all expenses or losses are generally deductible if they were incurred after the commencement of trade. But the Act specifically allows for any costs that were incurred or any expenditure or losses incurred before the commencement of that trade, once the trade has been carried on. The requirements for it to be an allowable deduction is, firstly, the trade must be carried on. Expenditure or losses must have been incurred before the commencement of trade, but in preparation of carrying on the trade. So that's important. It's before the commencement of trade, but it should be in preparation of that trade. And these expenditure or losses were not previously deducted for tax purposes. Okay, so we're going to go through an example a bit later, well, a question a bit later, which deals with this. But what this section basically says, that you may deduct any expenditures or losses made before the commencement of a trade if it's in the preparation of carrying of a trade, and if you have not deducted any of these expenditures or losses previously. So repairs, those are also allowed, but it has to be incurred for the purpose of trade or in respect of which it is receivable. So repairs effected to the property occupied for a purpose of a trade or in the respect, it repairs any it excludes any repairs of a capital nature. So again, that's what we went through previously. So is this repair to replace something or to renew something? Then yes, that is an deduction. If it's just an improvement, then that's of a capital nature, so it's not an allowable deduction. So in employee related expenses, so basically what this section goes through is any and all employer or employee related expenses which an employer may incur. So generally wages and salaries paid to persons working for a taxpayer, that's allowed as a deduction, but on top of that there are also many other deductions or specific deductions allowed in terms of section 11. So the first one is any annuities in respect of former employees, section 11M. So any annuity paid to former employees or former partners in terms of Section 11 are fully deductible if these former employees or partners retired because of old age, infirmity, or ill health. So those are the requirements for you to allow an annuity. It has to be an annuity paid after retirement or for retirement, and it's because of old age, ill health, or infirmity. Okay, contributions to funds, Section 11L. So the employer may deduct any amounts contributed for the benefit of the employee into fund contributions. So any pension fund, provident, or retirement annuity fund, that is an specific deduction allowed which the employer may deduct from his taxable income. And there's no limitation to these deductions. So yeah, if an employee has a pension fund, a provident fund, and a retirement annuity fund which the employer pays, then you may deduct all of those. So contributions made to medical aid are deducted in terms of Section 11A if it can be proven that it was in the production of income. So if your employee works for you and you pay for his medical aid, then you may deduct that in terms of if the work he does is for carrying on your trade. Okay, restraints of trade payments, Section 11CA. So again, that's what we dealt with earlier. So you've got this company or this employer, and he or any skills or trade secrets an employee learned from an employer in respect of a business or carrying on the trade of business. So that's some intellectual property or some information, important information he learned during his work, during his tenure at this, working under this employer. So if this employee can use this information in his own business or for a competitor, then the employer may enter into a restraint of trade agreement with the employee. So in other words, the employer, they may enter in agreements where the employer states to the employee that he may not use this information for a period of 3, 4, 5, or however many years. Thereafter, the employee may use it, but before then, there is an agreement in place, so he may not use it. So the employer will have to pay the employee a restraint of trade payment. So only if the employee is a natural person or a labor broker. So that's according to the 4th schedule. So if the employer pays the employee a restraint of trade payment, then that is the amount that is allowed to be deducted. So if the payment constitutes an income for the employee, the amount deducted may not exceed for any years of assessment that the lesser of, firstly, the amount incurred equal to the amount divided by the number of years or part thereof during which the restraint agreement will apply, or 1/3 of the amount incurred. Okay, so again, if this payment for the employee is his income, then you need to determine, then the allowable deduction will then be whatever is the least between the payment you made divided by the number of years of restraint, or 1/3 of the amount incurred. So whichever is less. Okay, so just a quick example. ABC Limited made a restraint of trade payment of 160,000 to a retiring engineer, Mr. Pilani, on the 1st of March 2017. Pilani was restrained from competing with the company for a period of 4 years. This money is taxable in the hands of Pilani. So calculate the amount that will be deductible in the current year of assessment. So firstly, what was the amount paid? 160,000 Rand. Now, what are you allowed to deduct during the current year of assessment? So you're allowed to deduct 1/3 of the money incurred, or the money incurred, the payment made, divide by the number of years of restraint. So in this case, that's 160,000 divided by 4 years, so that's 40,000 Rand, or a third of 160,000 is 53,333. So the 40,000 Rand is less. So that's the allowed deduction, is the 40,000 Rand. And you're allowed to deduct this 40,000 Rand for a period of 4 years. So each year it will be 40,000 Rand. Okay. So other thing, or other important specific deduction is ownership agreements. That's in terms of section 12H. So, and employers are incentivized under this section to provide learnership programs to employees in order to encourage skills development. So this deduction is only allowed if the employer has entered into a registered learnership agreement during a current year of assessment in a course of trade. So any learnership agreement or any further studies which an employee embarks, that is an allowable deduction for the employer if it is a registered learnership agreement and if it relates to the trade of the business. Okay, and what may you deduct? So firstly, 40,000 Rand for any able-bodied learner, so any person who does not have a disability, for if he completes an NQF level 1 to 6, and 20,000 Rand for a learner who completes an NQF level 7 and up. So that's what you guys are doing now, NQF level 7, I think. So that's the allowed deduction. If this employee is disabled, then you may deduct 50,000 Rand for every disabled learner completing an NQF level 7 to 10, and 60,000 Rand for those completing an NQ level 1 to 6. NQF level 1 to 6. So these are values that you need to learn and study. It's not difficult to remember them, but it's not something you will get in a test, or it's not the value you won't get in a test. You need to remember the 40,000 Rand if it's an able-bodied, and 50,000 Rand for disabled, or 60,000 Rand. Okay, so you need to study these values. Okay, so other employee-related expenses are bad debts. That's in terms of section 11I. So that's just any of the employer's debtors who do not pay back the money they owe, and where you know that you will not be able to recover this money. That's bad debts, and you may deduct that amount. But it's only deductible if it was previously included in income during the current or previous year of assessment. So that's important. You have to have included it as your income. So remember from the gross income definition that it is any cash received or incurred during the current year of assessment. So in this case, it's not money you actually received, but it's money that was incurred to you. It's money that you will still receive, but now you haven't received it, so it's your bad debt, and you may deduct it as a allowable or a specific deduction. And it has to be debts from trading activities, not loans to workers. Okay, so that's pretty straightforward. So doubtful debts in terms of section 11J, basically what that means is debts which has remained unpaid in the expected time. So the allowable deduction is amount equal to 25% of the total doubtful debt, and it must be added back to the taxable income in the following year of assessment, when new allowance will be calculated and allowed as a deduction. So essentially, these are debts which you believe might become bad debts, but it's not certain yet. So then you may deduct 25% of the doubtful debts during the current year of assessment, but during the next year of assessment, you must add it back to your taxable income. And then you will have to calculate a new allowance as your deduction. Okay. Then an allowance on credit sales or debtor's allowance in terms of section 24. If goods sold on credit, the amount assumed to be accrued on the day of sale, excluding finance costs, that is allowed. So the tax system provides relief on amount accrued by but not yet received. The taxpayer must be allowed a debtor's allowance if there is an agreement of sale. So the debtor's allowance is based on a taxpayer's gross profit excluding finance charges. So this amount must note and will not increase the assessed loss of the taxpayer and therefore must be added back to the taxable income in the following year. Okay, so essentially any debtor's allowance, that is an allowable deduction, but again you have to add it back during the next financial year or the next year of assessment. So legal expenses, the general rule is if the expense which caused the legal expense is deductible, the legal expense is also deductible and vice versa. So if it is in the production of income, this legal expense or legal cost, then yes, you may deduct it. And yeah, it must be incurred in respect of any claim, dispute, or court action arising from the ordinary course of a taxpayer carrying on business. For an allowable legal expenses incurred in the production of income, casual connection with the taxpayer trade is sufficient. So legal expenses incurred for due purposes, one deductible and the other not reasonable. Yeah, so you need to determine if you have any legal expenses as for two different things. Whatever relates to the carrying of the trade or the production of income, that is your allowable deduction. Otherwise, it's not a deduction. Okay. So donations in terms of section 18A is allowed or as an allowable or specific deduction, but very importantly, it must be supported by a section 18A receipt or certificate issued by the recipient of the donation. Okay, if there's no section or if there's no 18A receipt, then it will not qualify as a deduction. Okay, and donations also have specific tax rates and taxes relating to it, but that will be dealt with at a later stage. Okay, future expenditure on contracts, section 24C. So that is what we went through when we spoke about a building project. So a building project, you've got your contractors and they need to buy certain material before they can commence their work. So these expenditure which is being incurred for the future work that will be done, that is an allowable deduction. So the advance payment is included in the gross income. So yeah, firstly what you need to do is you need to calculate what the advance payment is and you need to include that within your gross income in terms of section 24C. And how you calculate it is you need to use the cost as a percentage of the contract price multiplied by income received or accrued in advance, less the actual expenditure incurred during the year of assessment. And the allowance may not exceed the amount received or accrued. So we're going to go through an example a bit later which explains this, but basically what it says is any future income that you will receive from this expenditure you should include in your gross income, and you need to calculate the deduction as the cost as a percentage of the contract price multiplied by the income actually received during the current year of assessment, less the actual expenditure incurred during the current year of assessment. Okay. So foreign exchange transactions. So this basically relates to you buying products from overseas, and with the fluctuating foreign exchange rates, you might incur a profit or a loss. So that we saw now in South Africa. Last year, September, October, the rand was at about 14 rand, and now it is at 11 rand 60, 70, 80. So some people made some profits or some people made some loss. So according to the Tax Act, any items you buy from overseas or in foreign currency, you need to convert to South African rands. And when you convert it to South African rands, you can either make a gain or a loss. And some important dates before we go into this, important dates is firstly your transaction date. So that's the date on which the debt actually incurred. So when you commence this transaction, your translation date is any year end subsequent to the transaction date and prior to the realization date. So you've got your transaction date, which is when this occurred. Translation date is the date at the end of the current year of assessment. So that date should be after the transaction date, but it should be before the realization date. What is the realization date? The realization date is the date the transaction is finally concluded. So in order for you to determine the deduction or the deduction allowed, you need to determine what profit or loss you made with this foreign exchange transaction. So the profit or loss is the amount between the realization date and the transaction date. But if the year of assessment is before the realization date, then your foreign exchange profit or loss is the amount is the difference between a translation date, so the date at the end of the current year of assessment, and the transaction date. Okay. And during the next year of assessment, you need to then calculate, or you can then deduct the amount between the realization date and the translation date. Okay, so it's very straightforward. You just need to look at the dates and focus on that. Okay, and then some expenditure and allowance relating to a capital asset. So expenditure of a capital nature are not deductible in terms of the general deduction formula. So you remember that from the definition. But there are some capital expenditures that are allowed. So that's in terms of section 11A. So capital expenditure to develop or acquire certain intellectual property like patents, trademarks, or copyrights. So section 11GC provides an allowance on expenditure that is actually incurred by a taxpayer to acquire any invention to be patented. So if you patented anything, then you may deduct that those costs for the patent, but the expenditure may not be more than, or the expenditure is limited to 5,000 Rand. If it is more than 5,000 Rand, then you may only deduct 5% of the value of the value. Okay. So essentially you may not deduct anything more than 5,000 Rand in total. So that relates to your patents, invention, or copyrights, but you may also deduct 10% of any expenditure in respect of a design of a similar nature. So other expenditures that of a capital nature, which is specific deductions or allowed deductions, are research and development expenditure, business licenses, repairs, occupied for the purpose of trade or in respect of which it is received. So it should be affected to property occupied for purposes of trade or in respect. So again, when we did repairs previously, it should be for the actual carrying of trade in the production of income. Okay, and finally, assess losses. So what are assessed losses? The balance of assessed loss is allowed as a deduction in terms of section 21A as carried forward from the preceding year of assessment. An assessed loss is when your expenditure was more than your income received. Then what you can do is during the next year of assessment, you can take that loss you made and you may add it back to your taxable income. So in other words, you won't pay tax previously, you might pay some tax now. So that's exactly what I just said there. So the example, so let's look at the example. Powervis Limited had an assessed loss of 300,000 Rand during the 2015 year of assessment and did not carry on trade in 2016, but recommenced trading in 2017 when it derived a taxable income of 450,000 Rand. So what is your taxable income for this? So in 2015 you made an assessed loss of 300,000 Rand. In 2016 there was no loss because you did not trade, or you didn't trade for 2016, but in 2017 you made a taxable income of 450,000 Rand. But because during the previous previous year of assessment you did not trade, you didn't have any losses, then you may not add back or subtract the assessed loss, that 300,000 Rand. Okay. So in summary, what we did is we focused on your specific deductions in terms of section 11 of the Income Tax Act, and there were some specific deductions which was because of a capital nature, your patents and fixed asset use for scientific research, and also some deductions that actually have not some costs that have incurred, but the income has not received yet. So there are certain special provisions made within the Act for these, and that is what we focus on. So what you need to do is you need to go through this by yourself, and you also need to look at that summary sheet that I gave you. And from that you will be able to and then you need to just look at some questions, go through questions. That's the only way to learn, is by going through questions and practicing. Okay, so on that, let's go have a look at some questions. Okay, so this is question 1 in your study guide, and let's go through this. So it says, Amatlala Pty Limited, whose financial year ends the last day of February, entered into a contract to build a bridge on the 20th of February 2016 for a contract price of 1.5 million. The quantity surveyor of Amatlala estimated that it cost an allowable deduction of 1.2 million Rand in the carrying out of its obligations. So I made a few small changes to this question, just because just to make the question or the numbers, the values round, and so you don't have some amounts that has decimals and stuff like that. So that's what I did, but the concept is still exactly the same. And a change I made here was that the allowable deduction is 1.2 million instead of the 1.15 million which they determined. Okay. So as per contract, Ahmad Allah received a payment of 850,000 Rand on 26th of February 2016. It commenced work on the contract on the 3rd of March and completed the work on the 13th of December, when the balance of 650 Rand became payable by the client and incurred an anticipated expenditure of 1.2 million. So, important for this section is you need to draw yourself a timeline. So if you just look at the requirement says determine the taxable income for the 2016 and 2017 year of assessments, assuming the above is the only income and expenses. So what we're going to do is we need to calculate taxable income for both the 2016 and 2017 year of assessment. So for this section, you need to draw yourself a timeline. Here they tell you that the financial year end is on the last day of February. So in other words, we look at a 2017 financial year. That means that the financial year end is 28th February 2017. But we started this project on the 20th of February, we entered a contract to build a bridge on the 20th of February 2016. Okay. So that is basically just before the 2016 year of assessment, which ended 20th February 2016. So that's so from the 20th of February to the 20th of February 2016. That's part of your 2016 year of assessment. So the 1st of March until 20th February 2017. That's your 2017 year of assessment. Now, for all of these parts, you need to determine whether it relates to the 2016 year of assessment or the 2017 year of assessment. Okay, so what we have here is we have a contract to build a bridge, and the total income that we will receive is 1.5 million. But the cost or expenditures which is allowed in terms of the Income Tax Act is 1.2 million Rand. But we received 850,000 Rand on the 26th of February, and then we only started working, so that's part of the 2016 year of assessment because it's before the 20th of February 2016. So we're going to break up that payment there, and then and then we started our contract on the 3rd of March. We started it on the 2017 year of assessment because remember that starts on the 1st of March 2017, and we completed the work on the 13th of December 2016, where we received 650,000 Rand, the remainder of the 1.5 million Rand. And that's also when we incurred all the expected expenditure of 1.2 million Rand. Okay, so let's just break down this section. So firstly, so this section relates to your future expenditure. So section 24C, future expenditure on contracts. So there has to be a contract in place. So what it says is you need to first calculate what is the gross profit percentage. So the gross profit calculation is your contract price, which is 1.5 million Rand, less your estimated cost of 1.2 million Rand. So your gross profit is 350,000 Rand. Remember, I changed that 1.15 million to 1.2 million just to make it a nice round number because that should be 1.2 million Rand. So if we say 1.2 million divided by 1.5 million, we get a gross profit as a percentage of the price of 80%. So now during the 2016 year of assessment, our gross income is not the 1.5 million because we only received 850,000 Rand, but the remainder, the 650,000 Rand, we received on the 13th of December, but during the 2016 year of assessment, it was not unconditionally incurred to us. There was still a condition in place, being that we need to complete this contract. So that's in terms of MOI versus the Commissioner of Revenue Services. Okay, so our gross income is only the 850,000 Rand. Okay, now in terms of section 24C, we may deduct the allowance for the estimated portion of this 850,000 Rand to be incurred during the next financial year or the next year of assessment. So how do we calculate that? We just calculate this gross profit as a percentage of the price multiplied by the income we received during the current year. So that's then 650,000 Rand. Okay. So let's look at the 2017 year of assessment. Your gross income is 650,000 Rand, which we received on the 13th of December. Now we can add back the section 24C allowance for the previous year of 650,000 Rand. So our gross income is then 1.33 million Rand during the 2017 year of assessment. Our expenditure actually incurred was 1.2 million Rand. Okay, so the difference between these two is the section 24C, when in the previous year we went and we estimated the portion of the 850,000 Rand, and then that we could have added back to the next year of assessment, or 2017 year of assessment. Okay, so that's that one. Okay, and then the next part says during the preceding 2 years of assessment, Amakala had a assessed loss of 120,500 in 2014 and taxable income of 65,000 in 2015, before taking into account the 2014 assessed loss. Okay, so what does that mean is we can carry over any assessed losses we made to the current year of assessment. So if we look at it, that will relate to 2016 year of assessment. I did it here. So you may add back the balance of the assessed loss from 2015 in terms of section 21A. So it's your loss of 120,000 Rand plus then the 60,000 Rand taxable income. So you may only add back the 55,000 Rand. Okay. So that's fairly simple. Then it says part of the estimate expenditure of 1.2 million is payable to three key researchers who are to test the suitability of the new bridge design amounting to 105,000 Rand. Okay, so there. Okay, so here they say that this amount is already included within this 1.2 million Rand, so we don't have to do anything about that. It does relate to this bridge or to this contract, so it is in a carrying of the trade for the production of your future income, so we may include that. So, or yeah, it's already included, so we don't have to do anything. Then, if successfully designed, Amakala would want to patent this design, but the estimated cost for registering the patent of 34,500 Rand through attorneys was not included in the original estimate of 1.15 since it was conditional. The patent was successfully registered on the 30th of March 2016. So, yeah, we didn't include it in the 1.2 million Rand because there was a condition to this, being that we need to successfully apply for a patent. But during the 2017 year of assessment, we did apply for this patent successfully, and that's why we may include it. But remember, for any patents, you may only include, if the amount is more than 5,000 Rand, only 5% of the total value. So only 5% of this 34,500. So the patent registration is limited to 5% of 34,000. So our deduction is 1,725 Rand. Okay, and finally, Amakala entered an NQF level 3 learnership. So in the question in your tax guide, in your study guide, it didn't give you what level it is, but that is important because it will change the allowable deduction amount. So I just added this NQ level 3. Okay, so they entered in an NQF level 3 learnership agreement with 2 new employees for a period of 12 months each from the 1st of December 2017. So again, in your tax guide, it's from the 1st of January. I just made it 1st of December, just again for rounding issues, just to make it nice and round numbers. So one of the employees has a disability as defined. The agreement comply with the necessary requirements and are registered. Okay. So what can we allow? So in 2000, so again, when was this? On the 1st of December 2015, so that's during 2016 year of assessment. We entered in a 12-month contract or a 12-month learnership agreement. So in terms of section 12H2B, so it allows an allowance of 40,000 Rand, but only a portion of that 40,000 Rand was incurred during the 2016 year of assessment. So 3 out of 12 months, December, January, February. So it's only 10,000 Rand. And the other guy is disabled, so that means your allowance is 60,000 Rand for NQF level 3. So that's 15,000 Rand. Okay, and then for our 2016 year of assessment, if you add all of this up, then you get a taxable income of 200,000 Rand. For 2017 year of assessment, we need to do the learnership. So section 12H2B, the learnership annual allowance is then 40,000 Rand multiplied by the remainder of the 12 months, and 9 out of 12, and for disability is 60,000 Rand. After 12 months, this learnership is only for 12 months, so then you may deduct a section 12H3 completion allowance of 40,000 Rand, and for disabled persons a completion allowance of 60,000 Rand. So in 2017, if you add all of this up, then we made an assessed loss of 46,720. And during this contract or this project, we therefore incurred an taxable income of 153,000, which is 200 minus the 46,000. Okay, so yeah, that's question 1. It's not too bad, but it is practice. You need to go through this on your own, and you need to know the theory, the underlying theory. If you don't, then you will really struggle. Okay, I'm just going to do question 2 as well. So question 2 states that below are the income and expenditure accounts for Mloto Pty Limited, which derives income from letting property. So it's for 2018, 19, and 2020 years of assessment. It received rent of 150,000, 240, and 480,000. These are all the expenditures. All of them are allowed expenditures. And then if you take this, you add all of this up, you get expenditure of 367,900 and so forth. And then your net surplus or your loss is then this 150,000 minus the 367,900 is then for 2018 217,900 and so forth. In 2020 you made a surplus or taxable income of 109,100. So what is required from us? Determine the taxable income or assessed loss of Mloto Pty for each year of assessment, 2018, 19, and 20. So our net loss according to our account is 217,900. That's from there, right? It's your income minus your expenditure. Less alterations to property. So here we have alterations to property, but we know that of a capital nature, so that should not be included as part of your definition, as part of your deductions, because it's specifically excluded as part of the definition. So we need to subtract that. So in other words, we've got a assessed loss of 57,900, and that we're going to now carry over to the next year. So For 2019, we had a loss of 139,600. To add back from that we can subtract the property, alterations to property, because it's of a capital nature. It's improvements that you made. It's not replacements. If it was replacements, then it was allowed, but improvements are of a capital nature. So our assessed loss is 24,600. We need to add back the loss we made from the previous year of 57,900. So our balance of assessed loss carried to 2020 is then 82,500. Okay. Then in 2020 we actually made a income, well, we made a surplus, we made a profit of 109,100. From that we need to add back the property or the capital nature. So why this is different from that is just your simple maths. You could have said, yeah, minus 270,000 plus 160 equals then minus 57,000. So yeah, just your maths. It's just how you wanted to do it. Okay. So your assessed loss during 2020 is then 239,100. Less your balance of your assessed loss from previous year of 82,500 gives you a taxable income of 156,600. So this guy needs to pay tax on that amount. Okay, so that's it for today. Go through question 3 on your own, and then we'll go through that in class at some point. But if there's anything unclear, anything you don't understand, please don't hesitate to ask me. Pop me an email. Yeah, let me know. Okay, cool. Thanks.